Hello, my name is Cindy Kilmark. Thank you for joining me today. We're going to speak about accounting data generation. We're going to answer a few questions. What are the two most common methods of accounting? What is the time period concept? What is the revenue recognition principle? And what is the matching principle? Are you ready to begin? Cash basis accounting, also known as the cash method of accounting. Cash basis accounting recognizes revenues and expenses at the time the cash is received or paid out. Cash basis accounting doesn't recognize accounts receivable or accounts payable, and it doesn't work in invoices. Many small businesses use cash basis accounting because it's very simple to maintain and understand, and you don't have to have a lot of familiarity with accounting concepts and processes in order to make things work. The cash method of accounting makes it very simple to keep an accurate track of a company's cash flow. And since the transactions aren't recognized until the cash is received, the income isn't taxed until that cash is deposited into the bank. Cash basis accounting or cash method accounting is a very common starting point with new business owners or small business owners. It's a good option for companies that deal directly with customers and accept cash payments. Almost every adult this time of year who's ever purchased a box of Girl Scout cookies, for example, is familiar with cash basis accounting. You give the little girl in the green vest a $5 bill and she'll give you a box of Thin Mints. There are no bills or invoices. Every transaction is paid for with cash in one-on-one. Most businesses use accrual basis accounting. It means recording each transaction as it occurs. This method of accounting paints a clear picture of a business's revenues and expenses. Revenue is only recorded when it's been earned, and expenses are only documented when they've been incurred. Under accrual basis accounting, it's irrelevant when cash is received or paid. The other method of counting, the cash basis accounting system, isn't allowed by the GAAP or the generally accepted accounting principles. The major difference between cash basis accounting and accrual basis is simply the timing of recording the revenues or the expenses. While this method doesn't give an accurate estimate of what is actually in your bank, it does give you a much more detailed, bigger picture of the financial health of your company. This approach is a good fit for bigger businesses and companies that do a lot of invoicing with their customers. One example of accrual basis accounting, for instance, would be insurance payments. It might be a bill that as a company you pay every 6 months, but instead of listing that cost every 6th month, with the accrual basis accounting system, you would take that total 6-month amount, divide it by the number 6, and deduct that portion each month instead of the entirety. The time period concept. The time period concept assumes that a business's activities can be sliced into small time segments and that financial statements can be prepared for specific periods such as a month, a quarter, or a year. The basic accounting period is 1 year, and most businesses prepare annual financial statements. The 12-month accounting period reflected in a company's annual financial statement is known as a fiscal year. For some companies, fiscal years coincide with the calendar year. Others position their year-end date at the low point in their business activity for the year. As a mid-level professional, this concept is important because it sets benchmarks throughout the year and allows you to measure if you're meeting your goals or change your plan if you aren't hitting your targets to get back on course prior to the end of the fiscal year. The revenue recognition principle requires companies to record revenue when it has been earned and determines the amount of revenue to record. Effective 12/15/2017, businesses are required to recognize revenue by applying 5 steps. Identify the contract, identify the performance obligations, determine the price, allocate the price to the performance obligations, and recognize the revenue when it satisfies that obligation. The revenue is recorded when the products are delivered or the services are rendered and the seller has done everything listed in the contract to the consumer. The date of sale or the date that services are performed is when the customer is invoiced. The day of the invoice is not always when payment is received from the customer, however. Regardless, revenue is recorded in the period for which it's been earned, even if the cash has not been physically received as of yet. For an executive level professional, this is a very important principle to understand. As a matter of fact, without this information, it would be difficult to communicate accurately what's going on with your company to your shareholders. The revenue recognition illustrates that the actual dollar amount your company has recorded in its books is not a reflection of your company's value. When you complete a customer's contract and invoice the work, you record that income, even if the cash is yet to be received. Your books reflect the value of your work, even prior to cash changing hands. The matching principle is also known as the expense recognition principle. All expenses are recorded when they are incurred during the period, and the expenses are matched against the revenues for that same period. This ensures that all expenses are recorded when they're incurred and all expenses are matched against revenues. Of course, with all of these principles, there is a need for professional ethics. How you record expenses can have consequences that far outreach your company's walls and affect your reputation and in some cases even your community. It's important that these principles and concepts are followed in order to give an accurate representation of your company and its fiscal dealings.